For new investors, the world of financial markets can seem overwhelming, with a myriad of terms, strategies, and products. Two of the most commonly discussed investment vehicles are stocks and exchange-traded funds, ETFs. While both play a significant role in the market, they serve different purposes and cater to various investment strategies. This guide will break down what ETFs are, how they work, and how they differ from individual stocks, helping you decide which might be best for your financial goals. What are ETFs? Exchange-traded funds, ETFs, are investment funds that pool money from multiple investors to purchase a diversified portfolio of assets such as stocks, bonds, commodities, or other securities. ETFs are traded on stock exchanges, just like individual stocks, and their prices fluctuate throughout the trading day based on market demand. The key characteristic of ETFs is that they offer instant diversification. Instead of buying shares in a single company, you're investing in a basket of assets. For example, 1. A stock ETF may track a major index like the S&P 500, giving you exposure to the performance of 500 large companies. 2. A bond ETF may invest in government or corporate bonds, providing a steady income stream. 3. A sector ETF might focus on a specific industry like technology or healthcare. ETFs can be passively managed, aiming to replicate the performance of a specific index, or actively managed, where professional fund managers make decisions about buying and selling assets. What are stocks? Stocks represent ownership in a single company. When you purchase a share of stock, you own a small piece of that company and may have voting rights in shareholder meetings, depending on the type of stock. Stocks are classified into two main types. 1. Common stock provides voting rights and potential dividends. 2. Preferred stock often doesn't provide voting rights but offers higher dividends and priority in case the company is liquidated. Investing in individual stocks can lead to significant gains if the company performs well. However, it also comes with greater risk, as your investment is tied to the fortunes of a single company. Key differences between ETFs and stocks. 1. Diversification. 1. ETFs. One of the most significant advantages of ETFs is built-in diversification. 1. By investing in an ETF, you spread your money across multiple companies, industries, or asset classes. 1. For example, a single ETF tracking the S&P 500 gives you exposure to 500 different companies, reducing the risk of relying on the success of one. 2. Stocks. When you buy an individual stock, your investment is tied to the performance of that one company. 2. If the company succeeds, you may see substantial returns. 2. However, if it fails, you risk losing your entire investment. 2. Risk and reward. 1. ETFs. Because ETFs are diversified, they tend to have lower risk compared to individual stocks. 1. However, this also means the potential for very high returns is lower, as gains from one successful company may be offset by losses in others within the fund. 2. Stocks. Investing in individual stocks can lead to significant rewards if you pick a winning company. 2. On the flip side, if the company underperforms, your investment may take a significant hit. 3. Trading and liquidity. 1. ETFs. ETFs are traded throughout the day on stock exchanges, and their prices fluctuate like stocks. 1. This liquidity allows investors to buy or sell shares at market prices during trading hours. 1. However, ETFs may also have bid-ask spreads, the difference between the buying and selling price, that can slightly impact costs. 2. Stocks. Stocks also trade on exchanges and are highly liquid. 2. Large companies with high trading volumes tend to have narrower bid-ask spreads, making them more cost-effective to trade. 4. Cost structure. 1. ETFs. While ETFs often have low expense ratios, annual fees charged by the fund manager, they may also incur trading commissions when you buy or sell shares. 1. However, many brokerage firms now offer commission-free ETF trading. 2. Stocks. There are no ongoing management fees for stocks, but you may pay trading commissions or fees when you buy or sell shares. 5. Tax efficiency. 1. ETFs are typically more tax efficient than mutual funds and sometimes individual stocks. 1. When the fund manager rebalances the portfolio, it doesn't usually trigger a taxable event for shareholders. 1. Tax obligations arise only when you sell your ETF shares. 2. Stocks. When you sell stocks at a profit, you'll pay capital gains taxes on the earnings. 2. If the company issues dividends, you may also owe taxes on those payouts. 6. Management style. 1. ETFs. Most ETFs are passively managed, meaning they aim to replicate the performance of an index rather than beat it. 1. This approach keeps costs low and provides consistent returns relative to the index. 1. Some ETFs, however, are actively managed, which can result in higher fees. 2. Stocks. Investing in individual stocks requires active management on your part. 2. You'll need to research companies, track their performance, and decide when to buy or sell based on your analysis. Which should you choose, ETFs or stocks? The choice between ETFs and stocks depends on your financial goals, risk tolerance, and investment knowledge. ETFs may be ideal if 1. You want diversification without needing to buy multiple individual stocks. 2. You're a beginner investor looking for a low-maintenance investment option. 3. You prefer lower risk and steady long-term growth. Stocks may be ideal if 1. You enjoy researching companies and are confident in your ability to pick winners. 2. You're willing to take on higher risk for the chance of higher rewards. 3. You want to build a custom portfolio with specific companies you believe in. Conclusion: ETFs and stocks in your portfolio. ETFs and stocks both have their place in an investment portfolio, and the choice often comes down to your goals and comfort with risk. ETFs provide an excellent foundation for diversification, particularly for beginners or those looking for hands-off investing. On the other hand, stocks offer opportunities for potentially higher returns if you're willing to invest the time and effort into researching individual companies. Whether you choose ETFs, stocks, or a combination of both, the key to successful investing lies in understanding your goals, maintaining a disciplined strategy, and being patient as your investments grow over time.